Why does asset location matter? Well, what types of investments you hold in which accounts can play a big part in how much tax you pay now and in the future. Click the link in the description of today's episode in your podcast app to go to the show notes and download our brand new guide on why asset location matters for free. Today in this jam-packed episode of Your Money, Your Wealth, we talk about stimulus payments for self-employed, dependents, and those who message us on Facebook, the Paycheck Protection Program, round 2 of which started since this episode was recorded, coronavirus-related distributions, Roth conversions, tax loss harvesting, the solo 401k, and yes, we even have a few derails at the end of the episode. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
We got one from Kelsey. Hello, my name is Kelsey, and I have a question about the stimulus checks. My parents claimed me as a dependent in 2018. Neither of us filed for 2019 yet. If they file soon and will not claim me as a dependent, will I be able to get a stimulus check? I'm a 22-year-old college student and live and pay rent on my own, so I'm independent. Also, my dad is self-employed and does not set aside taxes with each paycheck, so on tax season, they owe a lot. How much will it cost them not to claim me as a dependent? So there's two questions here, Big Al. One's a tax question. So she's claimed as a dependent. She's 22 years old. So...
Yeah, and presumably a full-time college student, which means her parents can claim her as a dependent, but there's very little benefit.
There's zero benefit, right?
I mean, in the past, you got about a $4,000 deduction for a dependency exemption, and that went away in 2018 with the new Tax Act and Jobs Cut Act. But at any rate, yeah, there's not much reason, Kelsey, for your parents to claim you as a dependent, and they shouldn't, because if they claim you as a dependent, you cannot get the stimulus check. So there's really no reason. Joe, I mean, there are some reasons why parents should still claim their kids. If their kids are 17 and under, they get the child credit. Right. So that's one thing.
Which is what? That's significant. So if Kelsey was 17 years old, that's a $2,000 tax savings. Yeah. It's a $2,000 child tax credit.
Yeah, per kid. So that's a big deal. Or, Joe, if you have a single parent, if they claim a dependent, then they can get head of household, which is a better tax rate, better tax rates. So I guess in this particular case, I guess, Kelsey, your dad could potentially claim your medical expenses, but that's probably not going to amount to any savings whatsoever because of the thresholds that you have to get over. So I would say there's no benefit for your parents to claim you as a dependent, so you should not. And then the second part is, how do you get your stimulus check, right? Because if you were filed as a dependent in 2019, or 2018, sorry, you would want to file 2019 right away yourself, so that you could get in the roll, so you can get your stimulus check. Otherwise, you got to wait till you file your 2020 return and not be a dependent on that return. But then you're waiting a whole year to get that money.
So if you haven't file. Tell your parents not to claim you as a dependent. It's not giving them any tax savings. I get it, because they're still used to old tax law, right?
Yeah, so exactly.
Like, yeah, hey, well, I'm going to claim you because I'm self-employed, and money comes in, and then it's cash flow is so all over the place when you're self-employed sometimes. So paying taxes, sometimes it's feast or famine. So I get what her dad's doing, but claiming her as a dependent is basically hurting her.
Yeah, and you're right. It used to make a big difference for your parents, but it doesn't anymore with your age.
Okay, cool. We got another question from the stimulus with Tennessee Dave. My question has to do with the Paycheck Protection Program, part of the coronavirus stimulus package. Well, thank you, Tennessee Dave, for explaining that. I'm self-employed and file as a sole proprietor and have just one employee, me. For what I understand, I can obtain a loan through this program, but I don't understand the rules by which this loan can be forgiven. It seems from what I have been able to read that I just have to use the funds to keep paying myself at the same rate as before the crisis to qualify for forgiveness, but this seems too good to be true. Do I have to demonstrate somehow that my business income was adversely affected this year? What if, after all said and done, 2020, my income really didn't go down? I am expecting a downturn this year, but don't know for sure and don't want to take on the extra cost of paying a loan back with interest if it's isn't needed, but also don't want to pass up what seems like could be free money. Can you clarify the rules as to how the program could apply to me? Thanks for your help. Tennessee Dave. Well, this is an interesting caveat we're in here.
It's a great question because the PPP loan, well, first of all, it ran out of money last week, being somewhere around, I think, April 16th. If you're listening to the show later, now we are at April 22nd, and I think the Senate just approved $320 million of new dollars.
Trillion?
So, yeah. Well, billion. What did I say? Trillion?
Million.
It was, it was a big number. Yeah. It was billion. Sorry. At any rate, so they have this rule, Joe, where you can the amount of loan that you can apply for is like 2 months of your salary, but there's a limitation on $100,000 per person, right? But then there's so self-employed. A sole proprietor doesn't pay themselves salary. It's the profit in the business that's the self-employment income. So that's what makes this kind of a little bit tricky, right? And so your self-employment income is going to be what you make, that couple months after you receive the PPP loan to determine whether you're going to get the loan forgiveness. And I've got to be honest, Joe, this is so complicated. I'm not even completely clear on the rules on the forgiveness yet. But what I will say is information seems to be coming out daily. And so I would just keep abreast of that. Unfortunately, that's the best I can do. What about you, Joe?
Yeah, I think what I would do if I was Tennessee Dave is I would apply for the loan, right? Because it's basically, here's the deal. It's 2 months of rolling payroll. So I don't know if he would, from that perspective, all right, so 2 months of his pay is what he's going to get as a loan. Is that worth it? And if so, go through the process to do it. And the worst case is that, let's say it's not forgiven for Dave. I mean, it's still a good rate. It's 4%. You get some cash, and then if you want to pay it all back right away, then do it, or it'll give you a little bit of a cushion with really good interest rates. So at the end of the day, if you have, let's say you make $100,000, what's the loan amount is not going to be anything crazy. If he makes $1 million, well, then it could be a couple $100,000 loan. But if he's making $1 million, I don't even know if he needs it or qualify.
Yeah, Joe, let me help you out. If he makes $1 million, it's limited, and it's just him. He's limited.
Oh, it's only at $100,000 of income. So right. So his loan amount is going to be.
And it's 2 months of that, right? So 1/6 of that. So call it 18,000, something like that. So this is from the Treasury. It says, how much of your loan will be forgiven? You will owe money when your loan is due if you use the loan amount for anything other than payroll costs, mortgage interest, rent, and utilities for payments over 8 weeks after getting the loan. So basically what they're saying is that 8 weeks after you get the loan, if you're using the money for payroll, mortgage, interest, rent, and utilities, it can be forgiven. But then there's all these tests, Joe, on how much income, how much salary you have to have. In the case of a sole proprietor, salary is profit. Salary equals profit and self-employment income. So that's what kind of makes it tricky for self-employed people.
All right. Hopefully that helps, Tennessee Dave. We got Tennessee Dave with a follow-up question. Didn't Tennessee Dave just also email us again today?
Oh, did he? I haven't seen that yet.
Tennessee Dave.
He's proficient. Like it.
Hi, Joe. Big Al. Want to do more Roth conversions this year while the stock market is down. I've heard you say that under the CARES Act, I can take an IRA distribution this year and pay the tax over the next 3 years instead of paying it all in 2020. If I take the distribution and convert it to a Roth IRA, can I still pay the tax over 3 years? Also, is there any limit to the amount of distribution I can take and still pay tax over 3 years? Thanks, Tennessee Dave. Tennessee Dave. Let's first of all, what he's talking about is the I guess the COVID or coronavirus related distribution from retirement accounts. You could pull up to $100,000 out of the retirement account, and you could either pay that retirement account back over a 3-year time period, or you could defer the taxes over a 3-year time period. However, you have to qualify for the coronavirus related distribution. And what the qualifications are is that you have to be diagnosed with COVID. That, right? You don't want that. Or your wife, dependent, spouse, kids, right? That were diagnosed with it. Or let's say you had kids that were in school, but now you have to stay at home to take care of them. That would qualify. If you got furloughed, laid off, you lost wages, maybe you're a small business owner that had to shut down. I mean, all of these are qualifications. But the last one that the IRS put in, Al, is interesting because it's pretty broad, right? It's like, well, anything that the IRS finds suitable will qualify.
Right. Pretty open-ended.
It's pretty open. So I'm not sure if you qualify, Tennessee Dave. So if you want to go for it, yeah, you know, there's so many things with this distribution day, Al, is that because a lot of people are affected by this virus, right? I mean, almost everyone is to some degree, it seems like.
Right.
And so now let's say I'm a retiree and I'm taking dollars out of my retirement account to live off of. So if I pull out $50,000 to live off of, but I'm affected by the COVID, does that mean now I can then pay the tax on the $50,000 distribution over 3 years, even though I have been taking distributions from my retirement account? Do CPAs really got to get involved and say, well, I see you took a distribution from your retirement account. Do you want to, defer the taxes over 3 years? Do you want to throw in to see if you qualify for this thing? So there's going to be, how about if you take out $50,000 today and, because you're hurting, right? I've been sitting at home for 6 months. I take those dollars out. I qualify, but I have it in my bank account. And then all of a sudden in December, things are better. I don't necessarily need it. So I'm going to decide to keep it, but then I convert it. I mean, there's so many different, I guess, nuances here that I'm not sure how the IRS is ever going to track that money.
Yeah, well, I think if you do qualify for this special 3-year rule, then it's actually retroactive to January 1st, but you do have to qualify. I guess I would say if it's a distribution, you can't convert a distribution to a Roth IRA, but you could put it back in the IRA and then convert it.
Yeah,
but you don't get the 3 years on a Roth conversion. It's 3 years for distributions. The whole point of this is if you need the money, you basically get to use it without having to pay taxes up front. And by the way, the 3 years would be the default. You pay the tax over 3 years, but you can elect to pay it in the first year, being this year. So if you want to pay the tax this year because your tax rate's lower, you can certainly do that. But then you also have 3 years from the date of the distribution to put it back in the IRA without paying tax. So you do have a couple choices. But yeah, you can't do this with a Roth conversion. It doesn't work.
But here's the deal, I think, there's additional planning that we're going to have to take a look at. Because right now, it's like, all right, well, if I take $100,000 out, I got to live off of it, and then you can pay the tax over the next 3 years, right? But how about if I pull $100,000 out, and then I can pay myself back over 3 years, correct?
Yeah, you
right?
can put it in, yeah.
So, but let's say I take it from my 401k plan, I put it into my IRA, and then let's say, convert some of that over the next 3 years. Maybe I have a 401k plan that I never had access to because I was under 59 and a half. I use this COVID-related distribution to take $100,000 out of my 401k plan. They waived the mandatory distribution. I put it into my IRA, and then from there, I convert that money over the next 3 years. I mean, right? So there could be some interesting things. Or how about if I'm already taking a distribution from my retirement account that I'm living off of? So instead of, usually I have to pay the tax this year for that distribution. So in this case, would then I split that distribution tax over 3 years?
Yeah, if you could, if you qualify.
Right, exactly.
Yeah.
So I just think that there's a lot more to this that we'll see later on this year.
Yeah, and I think a question might come up like, what if I decide to pay the tax over 3 years and then I pass away? And it can happen to some older people. Well, then your estate will have to pay the tax. So you don't run away from it. It still has to be paid.
That's kind of morbid, now.
I suppose.
But or another thing,
but you have to plan for worst case scenario,
Yes.
But I'm thinking if I'm my dad's age, no offense, Dad, but I'm I don't know if I'm going to be here 3 years.
Oh, wow.
Oh man.
Actually, he's told me he let's see, he will be 87 this year, and we talked about him turning 90, and he goes, God, I hope not. That's what he told me.
So he's pretty happy then, is what you're saying.
Yeah, very happy. Love and life. Living large. I'll tell you, my parents are in University City, and they're holed up, and life is not the best right now for them.
Yeah. I mean, life kind of is unique for all of us, for most of us, right?
Yep.
We got Robbie writes in via Facebook Messenger. I made a 2018. Okay. This guy's making a lot of things, Robbie.
Rob contributed to 18. 2008, he made 18.
I made a 2018. I made a tax return, the loan company, and they use the direct deposit information through their bank. But I get SSID through direct deposit at my bank. My question is, where will the $1,200 stimulus package money go to? Oh my God. So Robbie filed a tax return. And
for a loan company, I think, and they use the direct deposit information for the loan company's bank instead of his.
I
made a tax return, the loan company.
So he prepared a tax return for the loan company. That's what he did.
I made a tax return.
Yeah.
How do you make a tax return?
You just fill it out. You made it.
Oh my God. What's wrong with people?
I can answer this question, sort of.
Does it go to his bank? How can I fix to go to my bank? So, and I got this thing fixed. Just send them that link where it was like, when people don't know where the hell the money's going to go, there's a link that you can go and say, send it here.
And that's what I sent him. And it's irs.gov/coronavirus/economic-impact-payments. And I will put that in the podcast show notes.
Yeah. And if you don't want to remember all that, just type in irs.gov, G-O-V, and then it'll say coronavirus tax relief. And then it will say, check your payment status. And that's the first thing you do is you check your payment status. You got to put your full name, your social security number, and your address. And then it will tell you, has it been scheduled? And if so, it'll tell you what bank account it's going to. And it puts in the last 4 digits. I know this because I checked it for both my sons.
How about you? You're not getting one?
I didn't qualify.
Wow, look at the big wallet of Big Al.
Big income. I put mine in and said, no way, Jose.
All right.
Technically, you're only supposed to look for your own payments, but...
I have special power of attorney, so not to worry.
In addition to that IRS link to update your direct deposit or check on your check, I've also posted our CARES Act guide in the podcast show notes. Download it for free to find out about some of the recovery, retirement, unemployment, and other provisions that may benefit you in the stimulus package. And don't forget to share today's episode of Your Money, Your Wealth with friends so they can also make the most of the CARES Act as well. To access all the free resources mentioned in today's episode, just click the link in the description of the episode in your podcast app. And since this stuff is fairly complex, click the Ask Joe and Al on air banner there in the show notes as well, and send in any questions you have, either as a voice message or as an email.
All right, let's get to Cheatham in Chi-Town. Hi, Al and Joe. Thanks for the great podcast every week. Isn't this the guy that hated us, then liked us, and hated us, then liked us? Okay.
Well, I think so. I'm assuming so.
Well, didn't he got us confused with another podcast, right?
That's what he says, yes.
Yeah.
Got it. That's what they all say when we call them out on air.
That is true.
I'm a regular listener, by the way. Last time you read my question, you derived my location as Louisville-based. I'm actually asking from Chicago. All right. Anyway, thanks for helping many of us with very candid answers week after week. Here is my question. I went ahead and converted $15,000 of me and my wife's traditional IRAs to Roth to take advantage of the market drop. I understand we owe taxes right away on the $30,000 we converted. We will continue to be in the 24% tax bracket for 2020, even after conversion. My question is, when and how do I pay taxes on the $30,000 conversion? Waiting until next April is not ideal, is what I'm hearing. I had the option of automatically withholding the 10% or more during the conversion, but chose not to do it. Please advise. Thanks, and look forward to your answer on the air. All right. I don't know how old Cheatham is. I think he's younger. I'm guessing.
Yeah. I
under 59 and a half is what I'm saying, what I'm thinking.
Yeah. Yep.
So if he did withhold taxes on a conversion, if you're under 59 and a half, you would have been withheld a 10% penalty on the withholdings. So I'm glad he did not do that. So do not withhold taxes from a Roth IRA conversion if you're under 59 and a half, because the withholding will be subject to a 10% penalty. The conversion itself is classified as a rollover, but if you withhold taxes from a conversion, that doesn't classify as a rollover or a conversion. It's a distribution, and it's a non-qualified distribution that would be subject to the 10% penalty. So I'm glad you did not do that if you're under 59 and a half. Don't withhold taxes on anything when you're doing conversions. Now, when should he pay the taxes is question in regards to maybe penalties, Al. So if he converted $30,000, right? So he can wait until April 15th, but would he be subject a tax penalty for underpayment?
He might. I'll try to keep this simple, Joe, because this, as you know, can get sort of complicated. I think the best thing to look at is look at the taxes on your last year's return. So in this particular case, it's 2019. So you would have to know what that is, or at least have an estimate of what that is. And then you look at this year's withholding, right? And if this year's withholding covers last year's tax, you don't need to make an estimated payment, right? You just wait till April 15th, no harm, no penalty. There's one caveat to that, and that is if your income's over 150,000, your withholding has to be 10% greater than your tax. So just take your tax times 110%. If your withholding is at least that amount, you're good to go. Okay. If that's not true.
But he's in the 24% tax bracket.
Yeah. Well,
so, right. So his income's over 150.
Yeah. Well, that's a good point. Yeah. Good point. So he probably would have to do 110% of last year's tax, compares this year's withholding to that, and make sure that there's enough paid in. If there's not, then you would have to make some estimated payments. Those are due 4 times a year. Those are due in April 15th, June 15th, September 15th, and January 15th of the following year. And when you start making those payments is depending upon when you do the Roth conversion, right? So if you did the Roth conversion between January 1st and March 31st, then you'd have to make the first estimated payment April 15th. And the amount of estimated payment is 25% of what you would owe for the course of the year, right? So that's how that works. If you do the Roth conversion later, then it's a little more complicated. And I think I want to leave it at that because this can get so friggin' complicated to try to explain this. But I will say this, and this is what most people do. Most people say, I don't really care that much because once they understand the penalty is only a 3% interest charge, right? It's usually not very much.
Right. And it's a $30,000 conversion. So, with a couple percent interest, it's not going to be that big of a penalty if he waits until April.
Yeah, let's just say let's say 25% tax because it's easier math. So he owes $7,500, right? So then you divide that by 4 over 4 quarterly payments, and so let's say he didn't make the first one, which is something just under $2,000. So he'd get charged 3% of $2,000. So what's that? $60. That's the penalty on that payment. Second payment is over 10 months, so it's a smaller amount. So that's, it just gives you an idea. We're usually talking tens or maybe low hundreds of dollars in penalty, not thousands. And so if you're the kind of person that doesn't want to pay the IRS a dime more than you have to, then by all means take the time to compute it. But for all the rest of us, it gets pretty complicated.
All right, he's got another follow-up question. He's like, hey, Joe and Al, thanks for the great show every week. Your advice in Roth conversions really helped me. Thanks for that. I have about $250,000 in a rollover IRA from previous 402 plans. It's a 401k plan.
That's the other kind.
Those are the other
I think that was a typo. Give him a break.
No one gets breaks here.
Yeah, we read it as it comes out.
That's right.
402k. Have you heard of the 402k? We're not going to be able to answer this question, Joe, because we don't know about the 402k. I don't know what the hell
401k.
Cheatham's on the cutting edge here.
That's right.
So does it factor into pro-rata rule when I do backdoor conversion? I understand I can move this to a existing employer 401k plan, but prefer to keep it in a rollover IRA because I like the fund choices I'm in. Unless it impacts how you calculate the percentage of post-tax, pre-tax pro-rata rule. Thanks for everything you guys do. So I have about $250,000 in a rollover IRA from a previous 401k. Does that factor into pro-rata rule? So yes, it does. So the $250,000 that you have in an IRA, that's exactly what it's going to do because it's an IRA plan. So the pro-rata rule is based on all of your IRAs. So if you're making non-deductible IRA contributions and then converting them, that's a backdoor Roth conversion because Cheatham, as he just talked about in his previous email, is in the 22% tax bracket. So he might be disqualified from doing standard Roth IRA contributions. So he's doing non-deductible IRA contributions and then converting them. But that $250,000 is now going to be calculated in the pro-rata rule. So the amount of money that you're converting that is going to be basis or tax-free is going to be very, very low. So I would recommend you roll that $250 into the overall 401k plan or slowly convert out the $250,000 that you currently have over, you could do more conversions that way depending on what bracket that you want to convert to. So that's my thought on that.
Yeah, I agree with that. I think maybe what you do is you look at the investment choices in the 401k plan, and if really they're a lot worse than what you think you could do in your IRA, maybe it's not worth doing a backdoor Roth in that particular case. Maybe is he married from the last email?
Yeah,
I can't remember. So yes. you could have your spouse do it, all right, and maybe that's good enough. If the investment choices are really a problem.
Yeah, but I don't know. I mean, come on. I mean, there's the 401k plans now. I mean, they're all held up. Everyone's getting sued if they got a crappy 401k plan.
Yeah, well, yeah, but some are still, there's insurance companies involved sometimes, and they're not always the best of investments. But I agree with you. They're a lot better now than they used to be.
Sure. I don't know. I think maybe he wants to dabble into some other things.
That could be.
All right, we got Seabass.
No, it's not, Joe. Come on.
Kick his ass, Seabass. You don't know what movie I'm referring to, do you?
Of course not.
No. Okay. So It's what? How do you pronounce it then? Sabas?
That would be my guess. Or
I'm going to call him sea bass. I think
I'm
sea
sure he'll
bass.
love it.
That sounds so much better, right? That's a badass name.
This from the man who renames towns from Akron to Akron.
Yes.
So well, if he lives in Sacramento, he's probably not sea bass. Just saying.
I'm just going to say, kick his ass, sea bass, or Sabas. He's from Sacramento, 64 years old. When is the deadline to make Roth IRA conversion so I can use the conversion for the 2019 tax year? I already did one and plan to use that one for next year, but got to thinking I should do another one and use it for my 2019 return. Well, I'm sorry. You have to do a Roth conversion in the year of the calendar year. So
yeah, the year that you want it to show up on your income. You're absolutely right. Yeah, I think that people get confused, Joe, because a contribution you can do till April 15th, typically this year till July 15th, because of this extension on the taxes. And that's for 2019. So even though today we're April 22nd, you can still do for 19 a $6,000 contribution. And then another $1,000 catch up if you're 15 older. So $7,000, you can still do that, assuming you got earned income and assuming that your income is below certain specified thresholds of 122,000 single to 137 is the phase out. You see, I'm looking at my cheat sheet.
Yeah.
And married is 193,000 to 203,000.
All right. We got Tim. I was listening to a recent broadcast in which Joe responded to a question on tax loss harvesting. My question is, why the hell did Joe respond instead of Big Al?
That should be the question.
Right. My question is, if I sell a long-term stock in 2020 for $5,000 loss from purchase price and not purchase another stock right away, can I write the $5,000 loss up against estimated 2020 taxes owed of $5,000 for dollar, such that there would be no taxes owed? $5,000 tax owed minus $5,000 long-term loss equals zero tax owed. Tim, no, not. I mean, Big Al should have responded to that. That would have been really cool.
That'd be really cool. So the $5,000 loss is a capital loss, which you can use dollar for dollar against other capital gains. Right?
Yeah, but not after capital gains tax either.
That's right. It reduces your income, right? Not your tax, right? So, and then if you don't have any other capital losses, you can take $3,000 of that against ordinary income. So now your salary, let's just say your salary is $100,000. Now you get that $3,000 loss. Now your salary is like it was $97,000. So you pay tax on $3,000 yet less at your current tax rate. You know,
so yeah, that would save about maybe $1,500, right?
Yeah.
So it's not dollar. It's not like a tax credit. Is what he's referring this to.
Yeah, it's a deduction to save you in your current bracket.
So
and that's true. That's true for federal and state, by the way.
So the $5,000 capital loss will offset future capital gains. So let's say you have a stock loss of $5,000, but then you have another stock gain of $5,000. You sell the one that has the gain of $5,000. That loss will offset that gain dollar for dollar. So there would be zero taxes owed in that scenario. But if you have the $5,000 capital loss and you owe $5,000 of taxes, the $5,000 capital loss is not a tax credit. It's just a loss to offset future gains or a deduction of $3,000 against ordinary income. So
yeah, and I think I know of a I should say hypothetical, right? Just for compliance purposes, hypothetical situation where an individual was paying attention to the stock losses because they had a lot of stock losses with this market. They actually intentionally sold the stock at a loss. They bought something similar, so they're still in the market. That's what tax loss harvesting is. You intentionally sell at a loss, buy something similar, but in the meantime, you've got a big loss on your tax return. In this hypothetical example, it was $200,000. There was a lot of potential stock losses that were taken. Now, this individual then sold a piece of land, real estate, at a big gain and was wondering, can I net the stock loss against the gain? And the answer is yes. The stock, it's a capital loss against a capital gain. It doesn't matter what kind of capital loss or what kind of capital gain. Those two net together. So that's a case where if you're paying attention right now and you've got some stock losses, take advantage of them. Do tax loss harvesting. You can net them against other stock gains later, or you can use it against a property or any other capital gain.
Yeah, I mean, it's a phenomenal strategy to really take a look at to make sure that you can save future tax burden in the future. Unfortunately, it's not a tax credit. So next time, Tim.
If you skipped the intro of today's episode, you missed the fact that there is a brand new guide to asset location waiting for you to download for free. It'll tell you about a strategy that, hand in hand with tax loss harvesting, has the potential to lower what you pay in tax now and in the future. You'll also find our guide to the 5-year Roth clock, which outlines the Roth IRA withdrawal rules based on your age and some other factors. And thanks to Marion in Fresno, a regular listener who untangled everything Joe and Big Al have said on YMYW about those 5-year rules to help us compile that Roth clock guide. YMYW listeners help the fellas make this show as valuable and entertaining as it is. If you have a contribution, comment, or question, click Ask Joe and Big Al in the podcast show notes and send it on in.
We got one here. Hello, Joe and Al. This is Kent from Mission Hills here in San Diego. Hello, Kent from Mission Hills. Have you ever heard of a solo K? This is supposed to be a self-directed form of IRA where the account holder can deposit up to $63,000 per year tax-deferred. Since it's self-directed, you get invest into projects or stocks and bonds, etc., at your own discretion. Second part of that question is that something that can only be set up in Nevada. All right. You know how we wrote Solo K too? I think he went to like a seminar, Al.
Yeah.
And they were pitching like self-directed type products, like you could buy real estate and, who knows what the hell it is. But a solo 401k, all that is that if you're self-employed, you can set up your own 401k plan. Some people call it a solo 401k. Some people call it an individual 401k. It's just a 401k plan for a sole proprietor.
Yeah, that's exactly right, Joe. So you can do a self-directed one. We'll get to that in a second, but solo K you can do in the normal way, which is invest in stocks, bonds, mutual funds, that sort of thing. And you can put this current year, 2020, you can put up to $57,000 in. That would be the employee and the employer portion, both. Of course, you have to have that much income to be able to cover it. But let's just say you do $57,000 plus. If you're 50 and older, you get a $6,500 catch up. So you can actually do $63,500 in the current year. So that's true of all solo 401ks or solo Ks or individual Ks, whatever you want to call it. But I think you're right. I think Kent's talking about probably a seminar or webinar he went to listen to where they talked about self-directed IRAs, or in this case, self-directed solo 401ks. And a self-directed just simply means you can invest in assets that are non-traditional, which the most common, I would say, is real estate. That's what you see most people investing in. And there's nothing wrong with that. There's a lot of reasons why I don't really like real estate in retirement accounts, because you lose a lot of tax benefits, and we've done whole shows on that. But I'll just suffice to say it wouldn't be my favorite way to go, but you can do it. You certainly do not have to set it up in Nevada. It's anywhere you want to. Although I'm guessing that the seminar webinar that he went to is probably wants you to set up an LLC, and they probably suggested Nevada for privacy. So you can set up an LLC to hold an asset in your self-directed solo 401k. So now we're getting kind of complicated, but I think that's what he's kind of asking.
Yeah, I think everything that he's asking is that sometimes with these seminars, webinars, dinner workshops and things like that, they're creating, hey, this is something that's brand new, and they're trying to, just spice it up, that they're super experts in this area where it's a fairly common thing. But this solo K is like written all in cap letters. Maybe they called it something else. You know what I mean?
Yeah, no, I think that's exactly right. I can just imagine the presenter at this was probably when he said, I got something to share with you. And he probably looked around to see if anyone was listening. He goes, and this is for your ears only. And he probably said Solo K, and everyone, oh my gosh, Solo K. Well, that's what is that? I mean, that's kind of how some of these things are. And I don't want to make fun of it because maybe it's completely legit. But my feeling is usually with a self-directed IRA or self-directed Solo K, people tend to invest in real estate. And some quick problems with that is you have to pay all cash for the real estate, which is very hard to do, particularly when you live in San Diego with the price of properties. Second issue is when you need to repair your property, you're limited to the cash inside the IRA. And if you don't have any cash, you can't fix it. And if you put your own money in it, it's a prohibited transaction. Then when you get to age 72, you got to start doing required minimum distributions. And if there's no cash, it's you have a 50% penalty for not doing the required minimum distribution. And if you sell the property, there's no current taxation. But to ever get any dollars out of it, it's all ordinary income. And you've just taken the most tax efficient asset that there is, which is real estate, which is capital gain income, and created ordinary income from it. And furthermore, if you pass away, your heirs do not get a step up in basis on the property. They still have to pay ordinary income on the gain. Whereas if you own the property yourself, you pass away, the heirs get a step up in basis, which means the new cost basis is what the value is at the date of your death. So they can sell it and pay no tax. There's just almost, in my view, Joe, there's not a lot of good reasons to own real estate inside an IRA or 401k.
Also, you have to be self-employed. That's a missing link here too, right? You need to be self-employed to set up a Solo K.
Yeah, and you have to have profits in your.
And you need profits. And you can't have another 401k through your employer, right?
Right.
Here, you know what? I have a 9-to-5 job. I got W-2. I've already maxed out my 401k plan at my work, but now I'm going to set up the Solo K, and I'm going to put $63,000 into it, and I'm going to set up a LLC in Nevada and then purchase property or whatever it is. So just be careful with how things sometimes are presented. The Solo 401k is an individual 401k plan for self-employed individuals. $63,000 per year is the appropriate amount if you're over 50 and if you have the profits in the business to fund it. If you have employees, this does not work because there's rules in regards to setting up 401k plans if you have employees. Now you have to set up a safe harbor plan. And so just understand that this is for self-employed individuals. And if you are self-employed and you have the profits, by all means, you can do something like this. But maybe, he didn't even know, or who was this? Kent didn't even know that you had to be self-employed. So
well, and I think I've been to stuff like this or listened to it on webinars, and a lot of times they'll say, well, you just set up your own business, and so it's like, so you're thinking all I need to do is set up a business and not even worry about whether it's profitable. And if there's no profit, you can't do anything. And if you're already in another 401k, you can't even do any. Once you max out the 19,500 for individual or 26,000. So there's a lot of issues here potentially.
Okay, we got Brad writes in from Illinois. Hi, Joe, Al, and Andy. I love the show and listen every week. I had a question about conversions from a traditional to a Roth IRA. I live in Illinois. And as I understand it, Roth conversions are not taxable with regards to our 5% state income tax. My question is, can I convert $7,000 from a traditional IRA to a Roth IRA, paying the federal tax, of course, and make a $7,000 tax-deductible contribution? I'm over 50 to another traditional IRA in the same year. The effect on my federal tax would be a wash, but I would save $347 in state income taxes, 7,000 times 4.95%, since the traditional IRA contribution is tax deductible. But the Roth conversion is a non-taxable event. Am I interpreting this correctly? If so, would this strategy also work on a larger scale using my 403B deduction at work of $26,000 per year and then converting $26,000 from my traditional IRA to a Roth, saving $1,200 per year in state income tax? I appreciate your thoughts and look forward to your upcoming shows.
Man, Kenny from Granite City, Illinois really started something with this untaxed Roth conversions discussion.
You follow the math there, Big Al?
I do. And Brad, I would say we are not tax experts for Illinois, but assuming that what Kenny told us, we're going to just go with that Roth conversions are not taxable. Your logic, Brad, sounds sound to me. Again, I don't know the law in Illinois, so I'm just kind of going on what I've been told. But if that's true, if you can get a tax deduction for putting money into a 401k or putting money into a deductible IRA and then turning around and converting it and not paying taxes, and I'm talking state taxes only, federal taxes, of course, it's fully taxable. For federal taxes, it's a complete wash. But for state taxes, it sounds like, at least from my limited knowledge of Illinois tax, that does work.
Yeah, so the distributions on retirement accounts is tax-free. So you do the conversion, it's not going to be taxed. You do the deduction, so you're going to get the deduction. You save the money there, and then you keep doing this, so you get a little bit of a pop from the state of Illinois. So yeah, I like your thought process, Brad. Keep up the good work.
Your Money, Your Wealth is presented by Pure Financial Advisors. Click the free assessment button at yourmoneyyourwealth.com or call 888-994-6257 to schedule a free financial assessment video conference with a certified financial planner from Pure to take a deep dive into your retirement plan and to learn about the opportunities that are available for you to take advantage of in this ever-changing financial landscape. Visit yourmoneyyourwealth.com or call 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
You know what Facebook Messenger is, Al?
I do.
I do. Send it through our Facebook page.
Is that like a?
Yeah.
Is that
Pure Financial Advisors? He sent us a message.
It's like a special messenger service inside Facebook.
Really? I don't have Facebook.
Yeah, you have Instagram. Do they have a messenger in Instagram?
I guess it's a direct message, DM.
Similar kind of thing.
DM. Okay, got it.
All right. Yeah, you can DM me anytime.
Got it. Well, I think if you're 50 and older, you're on Facebook. If you're younger, you're on Instagram.
Got it.
That seems to be what's happened.
Okay, cool. We gotta. One more time.
You're just about at the 10-minute mark.
Oh. 888-994-6257. All right. What does that spell out again, Al?
What?
The telephone number.
Oh.
It's 99 goals, I think.
Oh yeah.
That's right. That's taking us back, Joe.
888-99 goals.
9 goals. Yeah,
Yes.
right.
Why did you stop using that?
You gotta have goals because no one knows how to goals. They're like, gee, what is that again? And you gotta write it down.
Everyone on their cell phone, you don't have it, right? So it's it's too complicated.
So you've had that number since back before cell phones? Is that what you're saying?
We've had that number for a while.
We had that before rotaries.
You derived my location as Louisville-based on my area code on my phone number. Yes, because Andy's a freak.
She's also known as a stalker.
Yes, I'm actually asking from Chicago. All right, we got Tim, regular listener. Oh, that's your notes, Andy?
Correct.
Oh.
I know where Tim's from, but I'm not telling you. Actually, I don't remember.
Got it. Okay. So Andy does a lot of recon work, just FYI.
Yeah. Well, I guess when it's...
You might have someone like just looking through your window shades at night.
It could be. Just turn off your Facebook account so she can't find you.